Hi, and welcome to another episode of my podcast. I'm excited for today's guest, Vessi Kapoulian. He is the founder of Dream, Believe, and Achieve Capital Group, otherwise known as DBA Capital Group, right? So,
Yes.
welcome to the show. Thank you for being here, and yeah, excited for it.
Yes, thank you so much for having me as a guest, Kyle. I look forward to our conversation.
Absolutely. So, first of all, would you mind just telling us a little bit about who you are, your background, and what you do?
Yes, happy to share. I'm a commercial lender by trade turned real estate investor. Actually, started my real estate journey a few years back, like most people in the residential space, and that was progressing well. And at that point, the light bulb went on, and I thought, wow, this can be something bigger and larger, and that's what prompted my transition from single family to multifamily. But what really prompted all that action were a few events, personal events that I went through. Like most people, I went to school and eventually found a job, started climbing that corporate ladder. And a few years into that process, I realized I was climbing the wrong ladder due to a variety of events that transpired, such as initially the global financial crisis. Along the way, my own employer went through a couple of restructures, and I saw dear colleagues of mine being let go. And last but not least, as I looked up the ladder, I saw a lot of people, particularly those in senior and executive management, trading more time for money. And I realized, well, it's not something to look forward to as far as looking up the ladder, but secondarily, what if I get laid off, or and my employer gets restructured, or we go through another global financial crisis? I don't really control these events, but what I can control is my own destiny. And at that point of time, I resorted to real estate. I grew up in Bulgaria actually, and at the time there wasn't really a developed stock market. And what when people talked about investments, they really talked about real estate and investing in hard assets. So in that moment of crisis, I resorted to what I knew best, which was real estate. And my first step was to purchase a single family home out of state, and that was initially going to be my little retirement nest egg. But as I mentioned at the beginning, over time that evolved into a larger residential portfolio, and now the transition to multifamily.
Awesome. That's interesting. I didn't know that you grew up in Bulgaria. When did you move to the? I assume you live in the States now. When did you move here?
Yes, I moved here a while back, officially over a quarter of a century ago. So this is really home now. But it was always my dream to come to the U.S. Initially, that really started when I started studying English, and my parents at the time said, "If you learn English, we'll send you abroad." And at the time, Bulgaria was a communist country, so leaving the country to travel anywhere was something unheard of, and not something anyone could ever dream of. Of course, after the wall fell, travel became easier and more accessible. So when I learned English, they actually fulfilled their promise. But learning English opened up a whole new world to me. Just not only the language itself, but culturally, economically. And the US became that dream that I had to come here and study. And eventually, I made that dream a reality. So I came here for college, and I've been here since. This is
Oh,
home now.
that's so interesting. I actually, my last podcast guest is from Nigeria. He grew up in Nigeria, so I love hearing.
No, very nice.
And he's kind of had a similar path. He's a doctor, but he's also an investor. He's doing quite well as well. So I just love hearing those stories of immigrants coming to this country and finding success in real estate. That's awesome. So, how? First of all, I like to. Um, curious, like how many assets have you acquired so far in your journey?
Yeah, so I have several assets within the residential portfolio. That's four. Within the multifamily portfolio, three. And I also invest passively. So I have three passive deals. My passive, since my active side is focused on the residential and multifamily space, my passive investments is how I diversify further. So I am not 100% in multifamily. So those passive deals are in alternative assets outside of real estate currently.
Okay, that's cool. Awesome. Thanks for sharing that. Um, how I guess how can you help people, like let's say someone was interested in investing in real estate? How could you help someone like that?
That's a great question. So I have a lot of conversations, very frequent conversations with investors, whether it's having a discussion about a particular deal or maybe investment that they're contemplating. But what my business does is I build strategic relationships with operators in emerging markets with strong fundamentals that are of interest to me. And when an investment opportunity presents itself from one of these sponsors or operators, I vet the deal, vet the numbers, and if it passes my tests, then I present it to people in my network that I have a pre existing relationship with so they can choose whether or not they would like to co invest with me.
Awesome. Yeah, well, that's kind of leads into what I was going to ask next. Because I do a lot of underwriting, and that's something that I really enjoy doing, and I think you do as well, um, from what it sounds like. So I'd like to talk about that a little bit. What are some key things you look for in a deal, if like for you to go ahead and move forward on it?
Yes. So once I vetted the operator and market, then I lastly look at the deal. For me, it's important that it cash flows on day one. So I look at those parameters. And lately, you've probably been hearing the words positive leverage quite a bit. But it's something I've historically looked at because I'm ultimately a cash flow investor, and so are people within my community. I also look at the assumptions that the operator is making in effectively modeling the future cash flows and how they're arriving at those pro forma returns to ensure really that I understand them and that I'm comfortable with them and that they're well supported. And last but not least, the debt structure and whether or not it corresponds to the business plan communicated by the sponsor. But when it comes specifically for the deal, those are some of the items that I vet up front.
Yeah, it's been tough. Like I just got started looking at deals in I think it was in July of this year that kind of started, and it's tough with new debt on these a lot of these assets. It's like going in, it's like a lot of them are negative leverage. So, what are some ways to, I guess, still make it work? Is my question.
Yeah. So first of all, if it's a property with tremendous value add opportunity, those are really hard to find. And by value add, I mean not a heavy lift necessarily, because especially in the current environment, at least for me, that increases the risk profile. But perhaps rents that were not brought up to market by the legacy owner, where there is a pretty substantial margin. Again, those deals are really, really hard to find in the current environment because rents have actually started moderating. So you're not seeing the big 10, 15, 20% gap that existed previously. So frankly, if the deal doesn't pass that pass my criteria, then I move on to the next one. Uh, I remember when I first started looking at deals, the market was extremely competitive, and I looked at a couple hundred before I found the one. Now the dynamics have changed. There isn't as much competition, but deal flow has reduced substantially. And of course, the debt markets have changed as a result of the right, continuously rising interest rate environment. So now the challenges are different. But it's always important to balance the desire to do a deal or close a deal with adhering to fundamentals. And sometimes it's better to pass on a deal that doesn't quite make sense versus just close a deal for the sake of closing one. But to answer your question, how do you deal with the negative leverage? Really, it's finding those opportunities where there is that substantial value add component that where you can close that gap within a year or two, um, and that's what I'm looking for as well when deals are presented to me.
Yeah, I like what you said about the value add. Like if it is like a heavy lift, like there's risk involved, but it also takes time to implement the business plan, and
Mhm.
just takes time for that leverage to correct, right? So it's I like what you said about just finding something that might be something that you can fix pretty quickly and
Mhm.
get that NOI up. So yeah, definitely. What I'm
Absolutely.
curious, something that I think is hard. One of the hardest things for kind of newer people to understand, especially for me, is the cap rate. Like
Mhm.
how to kind of interpret that and how to
Mhm.
project that going like let's say you want to project an exit in 5 years. Like that's probably one of the hardest things for me. So can you just
Mhm.
talk about that a little bit?
Yeah, and that's a very important question that you raise because apart from rents, cap rate is the other factor or key performance metric that has an exponential effect on the valuation. So, how it is set at entry as well as how it is set at exit can have a tremendous impact on the return results and the overall valuation of a deal. So typically what I'd like to do is again with the entry cap rate, that's typically the market cap rate, and depending on the rate environment, um, I will determine how much to increase it by at the time of exit. um, if you had asked me a year or so ago how much am I increasing it year over year, I would have said probably around 20 basis points because at that time rates were still on the lower end. Fed was raising rates very aggressively, and it takes some time, right, for cap rates to catch up. And frankly, they haven't even fully caught up with the extent of the rate increases. If you were to ask that same question today, I would say probably back to the 10 basis points of increase a year. Um, because I tend to believe that we are at the peak of the rate increases. And as of late, the Fed has been even intimating potential rate reductions later this year. And we'll see if those occur or not. But we're at a time where those increases are pausing or have probably already paused. And so I'm adjusting those modeling assumptions accordingly. Someone asked me the other day, well, why are you increasing the cap rate? Doesn't that make the valuation worse? And that's absolutely correct. When we increase the cap rates, that usually tends to bring the valuation down. But that's where the building extra cushion or buffers comes into play because there are a lot of things that we can control. With a particular investment, namely the operations, but there are exogenous factors that we cannot control, such as the market. I don't know where the markets will be 5 years from now when we typically exit investment opportunities. And so if the market is great and my cap rate doesn't reverse, then I've done well. But if it does, at least I've planned for it, so there are no surprises.
Yes. What's that saying? Plan for the worst and hope for the best, or something like that.
Yes, yes,
Yeah,
exactly.
thanks. And
Yes.
also, I guess on that note, you'd mentioned rents, kind of slowing down. Like in recent years,
Hmm.
like it wasn't really aggressive to project like a 3% year-over-year growth as far as rents go. But like now, it seems like they're kind of leveling, and some markets are actually dipping a little bit. So that's something that I've also been factoring in when underwriting. But I'm curious, like, how do you look at that? Just like, have you started looking at that differently in the past few months?
Absolutely. And the how we model or how I model that really would vary from market to market. One of the items that I or data points I also like to look at that directly impacts where rents will be headed is the absorption, which is effectively a measure of the demand and supply. That kind of tells me, okay, is the vacancy going to increase? Is it going to decrease? Where is the market headed? And that then determines how aggressive or conservative I would be in those rent assumptions. Also, understanding the long term historical average for a market. For some markets, it may be two, for some markets, it may be three. Some have already reverted back to that historical average, but perhaps they're in the process of doing so because, again, real estate is local, it's not a national market. So, even different cities right within the same state have different market dynamics or mini cycles, so to speak. So I look at that component as well, and then that helps shape my assumptions on how aggressive I'll go, whether I will even be aggressive in terms of increases, or maybe even not projecting any increases in the first year.
Yeah, there's so many different factors that you could look at going to look at in a certain market. And
Mhm,
I probably don't spend enough time doing that, but it can be very insightful just looking at all the data in a
mhm,
certain market. Like you said, it's very localized. Not
mhm.
all markets are the same. So yeah, that was very good. I would like to kind of maybe shift a little bit. I guess you have been a commercial lender, is that right?
That's correct. Prior to transitioning to real estate full time.
Yeah. I'm curious, how does the underwriting on the commercial, like as a lender versus a an operator, how does that differ?
So conceptually, there are two things. A lender would typically think through what are the risks that I'm facing entering into this deal. How do I mitigate those risks? What is my downside? Whereas as an operator, of course, we invest for profit, so we look at the upside and the opportunity with each particular investment. So for me, as I transitioned into the space as an operator slash investor, there was some adjustments that I had to do on my end to have a more balanced view versus a more downside kind of
Yeah.
scenario type of view. But the lender would also, as an operator, we model the future, and we talked about assumptions and projections a little while ago. And yes, the lender takes those into considerations as well because they want to understand your business plan with the property. But when they evaluate the deal or the investment, they really look at the actual and what is the performance as of today. Again, they will want to understand your plans and your track record and all of that. But when they size the loan, they're going to size it based on the actual numbers. So those are probably two key distinctions that come to mind, at least at the initial stage as one evaluates an opportunity.
hmm And so it's largely based on, if, correct me if I'm wrong, but it's largely based on the DSCR, right? Like they want to make sure it's like the asset is able to cover the debt, right?
Absolutely, particularly with banks and the agencies that look at stabilized types of deals. Cash flow is the number one factor. Once you start looking at the numbers and making sure it hits the minimum threshold for most lenders, it's 125 times net operating income over debt service. Now, of course, if you're working with a bridge lender in a situation where the property is not quite stabilized yet. There will be some heavy capex, or maybe the vacancy is under 90%, and there will be some work involved to bring it up, well, at least above 90, but preferably higher than that. Then in I apologize for the background noise. Hopefully, they can cut that out. But um, sorry, I think it's better now. But yeah, so they would evaluate the based on the cash flow, and then for bridge lenders, of course, very often you don't have that minimum that service met, because the property is in a turnaround stage or requires some work. So in that case, they will definitely put even more emphasis on the operator's track record and how many deals of this size and nature they've done, the exit strategy, reserves, and the profile of the guarantor or the sponsor for the loans.
Now, I'd like to switch gears a little bit. You started when you had your W-2, but it sounds like you been able to leave the W-2 and focus full time on investing. So, do you have like advice for maybe someone that is considering doing that, and what I guess is there like a certain income level you should be like replacement wise before you leave the W-2, or would you recommend just going all in on it?
I wouldn't recommend going all in. I know some people do that. That wasn't the approach that I took. In my head, I had what that freedom number will be, and I had a minimum, like a medium level, and then a nice to have aspirational number. And once I had that in mind, I really got to work. It was finding deals, evaluating deals, and getting into those investment opportunities either as an active investor or as a passive investor. Um, yes, you probably see on social media people making quick money and a lot of money, but that's really atypical. Real estate, even if you think of it from an accounting perspective, it's a fixed asset, it's a long term asset. So things don't happen overnight. It does take time for the business plan to take place. It does take time for the cash flows to increase, for the property to appreciate. So it's not something that happens overnight. It takes time. And probably the only regret I personally have is not starting sooner, but I'm really happy that I started when I did, because it gave me the option to exit the W2 world when I faced personal circumstances.
That was a good answer. Yeah, I'm one of those people that um, I actually did. I've been away from my W-2 for I'd say it's been close to a year now. No, it was in June, so it'd be more like a half a year.
Congrats.
Well, thank you, but I'm actually considering finding work again. Just because I'm not that I guess the number that I can just kind of live the way I want to. So I probably will.
Yes.
I probably will find something. But it's been good for me as well, just to kind of learn that what it takes to be, I guess, self-employed, and it takes some like I just work from home, so it takes some discipline to
Oh,
stay
yes.
stay focused
Yes.
and all that. So, but yeah, it's been a good experience. But yeah, it's also I'm considering actually doing something, finding some work again. So we'll see about that. But yeah,
Yeah.
I think definitely there's something to be said for actually uh, staying staying at the job or the W-2 uh, until you have a certain amount of passive income or that kind of a lot of that replaced. Yeah, for
Yeah.
sure. And
Yeah.
as someone as that, for me, I look at a lot of properties out of state. So, um, I know you have acquired some assets that are you don't live in the same state. So, I'd be really curious just to hear some tips on that, things to look for, and how do you kind of manage that, not being able to be at the property.
Yes, and I'll keep the discussion focused on multifamily. So actually, all of my investments are out of state because I'm based in Los Angeles, and my goal when investing is finding cash flowing properties. Not that it's impossible to do, but you pretty much have to buy them all cash or put a substantial amount down, which then requires a substantial amount of liquidity. Coupled with the regulatory environment, which is not entirely business friendly, so that shifted my focus to investing out of state. And when you do that, it's incredibly important to have the right team by your side. Specifically for the multifamily assets that I partner on, it's important for me that the key sponsors or operators are based in those markets or live within driving distance of those markets. So we have that or at least someone on the management team with experience is boots on the ground. So that would be number one. And then lining up your extended team. And by that I mean your property managers, asset managers, commercial lender, insurance broker, attorney, CPA. These are all trusted board of advisors, if I could call them such, that are instrumental in not only putting the deal together, but also providing that third party input, so to speak, when you are evaluating the opportunity, modeling the assumptions, and digging into the numbers.
Yeah, um I think it's important to like to have someone there to for the boots on the ground because it's not very economic to fly around to all these places to go look at something. So um,
Right.
yeah, I think that's huge, very important.
Absolutely. And in addition to that, a lot of times the local, for example, the property manager or even brokers, if you decide to focus on the acquisition side, they like to see that local presence, to have that frequency of in-person interaction. At the end of the day, this is still, I would call, a belly-to-belly business. Yes, a lot of things are still getting, or more and more things and interactions occur virtually in today's day and age. But at the end of the day, it's still a people's business, and the in person, face to face interaction is also key.
Yeah, I'm curious. So, what would you recommend to someone like me that's just kind of in the newer, like a newbie getting started? Just some advice on that, like finding a team, and I think that's the biggest thing people struggle with is like actually be able to
Mhm.
be part of a team. So, just anything you could share on that, great.
What worked well for me, particularly when I decided to make the transition into multi-families, I joined a mastermind. And yes, a big part of or reason why was the educational aspect of it, but really it's the network that it gave me access to, the network of people who are like-minded, equally motivated, have similar sets of goals and values. And I'm really happy that I did, because that most definitely accelerated my own journey and the transition into the multifamily space, because the people I met through that mastermind um, are now my current partners in the various investment opportunities that we have in the portfolio. Beyond that, I would say it's networking at meetups and virtual, in person or virtual conferences and other events, because it takes time to build those relationships. It's not something that happens overnight. And it's important to get to know your partners first, to make sure you have alignment from personal goals and values, really, to begin with. But secondarily, and not necessarily in importance, but secondarily, to ensure that you have complementary skills, right? If you get two underwriters on a team, well, that's all great, but someone else then, who's going to raise the capital, who's going to operate the asset. There are so many jobs, if you will, or projects that take place once you take over an asset. It's essentially like running a small business enterprise. So it's imperative that um, people have different ways they can step in and add value with, and that those roles and responsibilities are clear up front. And that. Yes. No, no, it's a lot. It's a lot to learn. And I've met people who have done maybe one or two syndications entirely by themselves, though I would say those are probably the exception. And sure, maybe you can do one, but I don't see how you can do more than that, because then your ability to grow, right, becomes more limited, because it is a lot of work. And again, if you're involved in absolutely everything, it makes it more challenging to focus and operate also. Absolutely. Yeah, I learned quite a bit from experience, and my very first raise was a miserable failure, but I learned a ton from it. Really, the first step being is letting people know what you do, and because again, in my case, a lot of people knew me as Vessi, the commercial lender, not necessarily as Vessi, the real estate investor, and it takes time for that messaging to sink in. So spreading the word, spreading the message, raising awareness, and then secondarily is educating people because maybe they like you as a person, they have that pre-existing relationship, but they don't know you necessarily as a real estate professional. They want to see you do one or maybe two deals or at least some sort of track record. So I'm talking about any prior deals or experience you have, while at the same time continuing to educate people about the space because they may be brand new to real estate or maybe they have some basic knowledge, um, specifically for residential, but not necessarily for commercial. And then continuing those conversations in various ways because everyone consumes information and data differently. Some people like to read, so maybe they would enjoy reading a blog or an article that you wrote. Others are more visual, so they would like to see a video or listen to a video. Um, some access the information via email, others access it via social media. So distributing your message in multiple distribution channels. It means a couple different things is and why I do this. One of my whys is to help people secure their own personal and financial freedom and create more optionality in their lives. And one way I do that is by educating. So I'm sharing a ton of complimentary education